Welcome to PhillipCapital's Weekly Market Watch. The Dow Jones Index has fallen 4% in the month of January, and investors are concerned with the high unemployment numbers and European sovereign debts. However, the employment reports released last week reflected better than expected results. So, what is the outlook for US market in the coming months? Let us find out from Mr. Adrian Chu, CFD dealer from Phillip Securities. So Adrian, going forward, do you think the US economy is on the road of recovery?
From a macro perspective, the Fed believes that economic activities will continue to strengthen. Deterioration of the labour market is flattening out and seems to be at a recessionary range. The risk of inflation remains low, hence there is no urgent need on the part of the Fed to raise interest rates in the near future. Moreover, with the recent discontinuation of temporary liquidity swap between the Fed and several central banks, and the winding down of several support programs reflect the confidence in the improved functioning of the financial market. With companies are reporting better than expected earnings, they are still reluctant to add payrolls, citing cost-cutting measures. These create a change of negative reactions from various economic sectors. For example, a stifled payroll and a headcount results in a high employment rate. And a high employment rate not only constrains households and consumer spending, it also affects home buys. Thus, in order for US economy to recover, we need a middle-class Americans to start spending again so as to push for a demand type of growth. Therefore, there is still a long way to go. The light of the tunnel, at the end of the tunnel, is getting brighter.
The US government has announced its unemployment numbers, which stands at 9.7%, the lowest since August 2009. Is this the turning point?
The figures look encouraging, but things are still murky at the moment. The government also reported that 20,000 non-farm payroll were lost in January, while economists were expecting a small increase. On the other hand, we have Cisco announcing that it will start hiring up to 2,000 to 3,000 employees this year. Other reports were also mixed. Construction industry lost 75,000 jobs, while manufacturing sector grew. The trend of temp hiring is increasing, and most economists view this as a leading indicator for the overall job market. As such, we have different economics indicators pointing different directions, which do not provide a clear picture on the employment situation. For now, it's best to wait for the next few months to see if the unemployment levels trims down to 9% before we could genuinely say that the US economy has turned for the better.
Any advice for investors in the near future?
Any upward movement in the US stock market in the near term is capped by the fundamental issue of unemployment. I will expect a rational correction of 10 to 15% if things do not improve. However, it will be supported by good fundamental valuation and bargain hunting. For long-term investors, healthcare remains a sector for growth because of President Obama's proposed health reforms. In addition, the recent proposed restriction on investment for commercial banks will give small regional banks a chance to strive. For short-term investors, they should expect volatility as the EU and China try to contain their domestic issues. They might want to consider investment tools that track a broader-based market to reduce their risk exposure in such uncertain times.
Thank you, Adrian. That's all we have for you today. Tune in next week for more market updates.